Voice is clear?
Yes, Neeraj.
Yeah, Neeraj.
Okay. Any doubt, please ask. Okay. And what I have done is one more thing. I got some time. So what I did is, if you see the PPT below, I mean slides below, what I have done is I have added some notes with respect to Narayan Hodale. Okay. So what happens is when we are analyzing, we are able to connect or have some actual numbers, okay, with some company analysis. Okay. Just one disclaimer that I have already invested in Narayan Hodale. So I have a vested interest and my opinion may be a little biased towards Narayan Hodale. So, but I'm not doing as such analysis, but included some numbers for your understanding. Okay. So let's start. So why and source, I have taken YouTube videos, articles, con calls, company financials, quarterly PPTs. Okay. And there's some CRISIL reports and all. Okay. So to start now, why hospital sector? So this image tells like it's 1,000 words. A picture is worth 1,000 words. So you can see even UK and US have almost 2 doctors per person, correct? So anyone who has faced any problem, mostly we see in a village, people come to cities, correct, for treatment and all. So that itself speaks, and the kind of population India has, that also will show a lower number actually. So, but I'm sure slowly will pick up, and there is a huge scope ahead of us. Okay. So if you see with adequate system, if you see only 1 doctor for per 1,000 citizen, and but if you see the expenditure, okay, 20 lakh crore is what is our healthcare expense, correct? And the quality of healthcare is very low. Quality healthcare is very low. So you see people coming from villages towards the cities, and generally it is growing around 13 to 14%. It's a good growth actually. And how do we analyze the hospitals? Means we can analyze different criteria based on business model, performance metric, financial metrics that I've already highlighted. I'll just show you. And then we can also we should also understand when we're analyzing hospital, whether it's a new hospital, okay, it's a mature hospital, or it's a new hospital, correct? Then whether it's a large specialty hospital, how is the pricing power, how is the talent pool? And then we'll see there are some regulatory risk also when we are analyzing hospitals. Okay. So if you see how, just I'll give you a structure. So basically, what is the business model, demand and healthcare capital requirement, classification of hospitals, then operational metrics. Okay. Operational metrics like diversification and competitive advantage, hospital maturity level, insurance penetration, regulatory risk, then key operational metrics, okay, occupancy rate, how we should see the revenue, okay, they're generating, then average revenue per occupied bed, what is the average length of stay, then what is the payer mix, okay, then financial metrics, so revenue growth, earnings growth, EBITDA margin, capex, EV to EBITDA, and then I have taken some summary of this one. All these things, when I have analyzed on the right, when you see I have taken a lot of data also of actual listed companies. So it'll give you a good idea of what we are going to analyze and some ideas. So very exhaustive PPT. It will really help you. And I'll share this Excel with all of you. So no need to note down anything. Okay. So let's start. Okay. So this we already discussed that industry is going at 13 to 14%. It's a good thing. Second, penetration is very low in India. Okay. Third, very important thing is if you see, it's a very low cyclicality business. So if you get a good hospital, okay, which is growing in your portfolio, it can really add a lot of value in terms of there is no cyclically attached to it, like metal sector. Metals are cyclical, correct? But hospitals are not cyclical. In fact, it can grow during pandemics and times like COVID or flu or things like that. Okay, so very important to know that. Okay, so if you are doing, if you are arranging your portfolio, I think you should have some exposure towards healthcare. Okay, because there's low cyclicality. Okay, Then coming to capital requirement. So what will be the capital requirement? It will be high or low for hospitals?
It is very high.
Very high, correct? So if there is a good hospital who is already established and there are some, they have already become mature. Okay, so chain of hospital which is old, already mature, throwing a lot of cash from old chain. So it is very easy for such hospital to establish new chain, correct? New geography or new building, correct? So all those hospitals who are mature, you will find their valuations will be little higher. So if you go to, if you see here, just to give you a eagle's eye view, what is happening basically, so that when we are analyzing, you will have some idea. Okay. So if you see the price to earning of Apollo Hospital, market cap is 83,000 crore, correct? But you see the price to earning multiple is 190. But other hospitals, when you see Max, which is also very good, okay, in terms of occupancy and all, which we go through, price to earning is 72, Fortis is 60, Global Health 60. So generally you will find price to earning is on more than 50, 60 kind of a thing. Okay. Narayana Hrudayalaya you see around 35, Dr. Lal is 67, Aster is here. So why such high P? When we analyze individual stocks, we'll come to know. But just if you see an average price to earning multiple is above 50, except Narayana Hrudayalaya. Okay. Now coming to market cap, if you see Apollo Hospital is the largest, 83,000 crore, followed by Max and then Fortis and Global Health, Dr. Lal. This is a basically diagnostic company, and Aster is 20,000 crore. Okay. Now there are some small players also like KIMS and all, which are small players. KIMS Hospital, if you see, market cap is around 16,000 crore, and there is one small hospital, Artemis, is 2,500 crore. So Artemis is basically parent company is Apollo Tyres. Okay. So just to give you an idea, it's a large group started by Apollo Tyres. You can see promoter is Apollo Tyres. Okay. So upcoming, but multiple is around 56. Return on capital employed, return on equity is around 11 and 10. But when you see other hospitals, return on equity is around 13, 16. Fortis is just 7. Okay. Narayana is 33. Return on capital employed is 31. So why I have compared with Narayana Hrudayalaya? Because what I see is there is a possibility of re-rating for Narayana Hrudayalaya. P is low, and in terms of return on equity and return on capital is one of the best in the industry, correct? When you compare all the hospitals, they have one of the best, and market cap is also okay. It's good actually. Okay. So that is the reason why I have taken Narayana Hrudayalaya as an example. Okay. So what we have understood is there is low cyclicity business, capital requirement is very high, and gestation period is also long, because when you start the hospital, starting from it may take at least 1 to 3 years also to complete the whole building. Okay. And then what happens? Patients starts coming, and then profitability may take some time. Okay. One important thing is with respect to Narayana Hrudayalaya is you have a chairman who himself is an architect. So this may be an added advantage for Narayana Hrudayalaya, because when you have someone from the group only, correct, it really helps when you start constructing new buildings, correct? So you have some insights. So the person, if you see Narayana Hrudayalaya, he is Mr. Viren Shetty, son of Dr. Devi Shetty. So you can see he's a civil engineer from RV College of Engineering, Bangalore. Okay. So that is why when you see earlier, when we have done when we analyze a company, it is very important that you see the promoter and its education and background also, correct? So this can be an added advantage when they are doing capex on new buildings. Okay. Then what happens is, once you start the hospital, results in losses initial years, correct? Because depreciation will be there, interest will be there, and it would end profitability. So what will happen is it become very tricky when you are investing in a hospital which is growing. what will happen is you will not see profitability unless they stabilize, correct? So capex would have already been done. So what will happen is numbers will come in future years, 2-3 years down the line, and initial years you may see the loss, and maybe share price may also not move, correct? And maybe that is the good time to start accumulating slowly, correct? So, and last is promoter commitment and good capability. Why promoter commitment? Because initial years what happens is you need capex, you need that money, correct? So promoter should be well funded, correct? He should be a good promoter. So if he's good in execution, it is very, very important that we see all those parameters, correct? Now coming to Narayana Hrudayalaya, how much capex they are doing? If you see capex, they are doing around 1,000 crores capex. Okay, so if you see the extract from Q2 Q3 con call, they are doing 1,100 crores of capex for the current year, and 400 crores is already done till now. Okay, so if you see the chart, okay, for different companies, so you can see Narayana Hrudayalaya last actual 23 they did 800 crores, and current year they have planned for 1,100 crores, correct? And same thing is what they have told in con call also. Max Healthcare around last year they did 400,000 crore, last year 597, 285, 450. Anyone can tell me what is the trend you are observing in all these hospitals compared to what they have already done and what they are planning?
A huge investment coming.
Yes, very good. So you can understand that they have observed that there is a gap, and obviously they feel there is a demand, and all the hospitals, not one or two, you can see here, all the hospitals are planning for good capex. Okay, and so now one more important thing, when I was going through the balance sheet, okay, for Narayana Hrudayalaya, there is and it is mentioned in the con call also. Okay, so when you see the, so what will happen is when you are incurring, where it will come? CWIP, correct? Capital work in progress, correct?
Yeah.
So when you see capital WIP, last you see around 250, 365. Okay. So what is happening is they would have already ordered the equipment. Okay. But if you see the gross block in 2020 is 1980 minus current 2460 is around some 500 or 600 crores, correct? It is less 400 crores. Last was around 800 crores, around 200, 250 crores you are seeing less actually, correct? Yes or no?
Yeah.
Why this is less is because when it was asked to the management, what they're telling is when they order certain equipments and all, if the building is not ready, the equipment will not come. Okay. So there is a gap actually. So even if though the management has told current year they will do 1,100, maybe they end up doing around 700 or 800 only, because balance 300, 400 crores equipment would have not come. So when you are analyzing the capex, please keep this in mind. So I have also mentioned here in the note, okay, when you are doing planning this, there is a lag of 6 months due to order of equipment. So please keep this in mind. It may not be always what they have told and actually would have already executed. Okay, so subtle point to just keep in mind. Then how do you classify the hospitals? So large super specialty hospital is more than 300 beds, small is less than 100 beds, and mid size is 100 to 300, large is 300 and above. Okay, smaller hospitals will have more daycare procedures or like that, but mid size will have inpatient and different specialties. More than 300 will have multiple specialties. Okay, then coming to operational metrics. So when you come to operational metrics, which will have, large will have more stable revenue or small will have more stable revenue?
We cannot exactly pinpoint that, Neeraj. But a larger hospital will have stable revenue because there will be high risk cases, and the bill also goes up very high.
Very good. And suppose more, if hospital has more of say cancer patients, oncology department and something which is more critical, revenue from,
then it will be very constant. The
Yes.
revenue will be constant
Yes.
for them
correct.
because people will get admitted repeatedly due to chemotherapy.
Very good. So please keep this in mind is if any hospital has such kind of facilities, then their revenue share and margin will also be little higher. Okay, like recently we had one case where person was diagnosed with cancer. Bill was, means estimate given by Ramaiah Hospital is 40 lakhs blood cancer, and treatment will go on for 6 months. Correct. So that patient will not go anywhere. Correct. Next 6 months he will be coming there, and then future all follow-ups and everything will go there. Correct. So very important, what is the mix of the hospital? Okay. Then again, hospital maturity level, like initial years there will be losses. Mature hospitals will have higher margins. Okay.
Yeah.
And stable.
High surgical intervention will have more revenue compared to the medical thing. So in medical thing, they don't make much money.
Correct. So that's why revenue mix is very, very important. Okay. Then coming to insurance penetration. So now here what happens now whenever I listen to so what they're telling is, in insurance, those hospitals who have very good tie-up, they have generally good footfalls. Okay. And second, what they told is revenue may be little less, margins may be little less if patients from insurance tie-up are more. Okay. Now from last 1 or 2,
compared to the cash, the insurance packages that they give will be little less, but there will be more footfalls because 90% of insurance is with PSUs. So these PSUs will give larger footfalls to the hospitals. Though the per bed revenue is little less, but because of the footfalls, it will cover up.
Good. So here just I want to disagree on 2-3 points from certain industry thoughts. So industry analysts, what they think is, and what we are observing actually. Okay. What we are observing is generally what they say is, when you tie up with insurance companies, so for example, normally if you go, it may charge 1 lakh, but if you go with the insurance tab, they may give you only 90,000 or 80,000 or 85,000. 10 to 15% is discount. Okay.
Yeah.
But slowly what is happening is that gap is coming down actually. Okay. For example, I'll not take the name of the insurance company through which we discussed with some claims head teams and the operation team who do tie up. Okay. What they're telling is, say for example, if they go to Manipal, they say, if you don't want to don't do tie up, don't do it, because the kind of goodwill Manipal has or the location they are. Okay. They don't care about whether insurance company comes for type or not. It's a reverse. If patient is going there and they don't have tie with certain insurance company, then that insurance company loses goodwill actually. Okay. So slowly what we are observing is the gap is slowing down. Okay. Hospital doesn't want to give too much discount. Okay. So what insurance companies are doing is they are trying to put some upfront deposit with all these hospitals to get more discount. Okay, that is point number 2.
This is happening only with private insurance companies, Neeraj.
Private insurance, yes.
Where the footfalls are very less, so they don't have muscle power to command on the hospital. So, but when it comes to PSUs, all these 4 PSUs like Oriental, National United, and New India have formed a group by name GIPSA, which is called a General Insurance Public Sector Association.
Okay.
So all these 4 insurance companies formed this group, and because they have 90% of health insurance with them, they started forcing the hospitals to agree for a lesser packages.
Okay.
And because of that, the revenue which is coming through insurance per case is very less. But when you see an overall, because 90% of the business is with PSUs, they are getting good footfalls.
Okay. So
but when it comes to private insurance companies, the private insurance companies are not able to negotiate properly because of lesser footfalls.
Okay. So very good point, Dr. Pawan. So I have put a note also here. Okay. So if it's a private company, so we can. So if company has more tie with private companies, you may not more with PSUs, you may see that margin compression. But if it is more of a private company, you may not see so much margin compression. Okay. Now coming to now coming to regulatory risk. Okay. Anyone, what kind of regulatory risk can have hospitals?
Because this new Ayushman Bharat and these things are coming, so the government is slowly implementing some restrictions on the price. They are reducing the prices of cancer drugs, they are reducing the prices of implants, like stents. I mean the heart stents, which usually used to be like 1 lakh, 1.5 lakh. Now it has been capped to 30,000.
Correct.
So these are the things, and even some imported implants are also had been kept under these regulations.
Correct. So I can share the articles, okay, where you can see where the stent and all is capped. So I've shown Bharat stent capping. So all these things you will see where there is a regulatory risk, okay, but it is not so much that is impacting their profitability. But yes, margins will come down if those procedures are there. Okay. Now, if you see the revenue growth, okay, of all these hospitals, which has the highest revenue growth?
Apollo.
No. KIMS. If you see KIMS have 55% revenue growth.
Yeah. Okay.
Correct. And followed by Rainbow Hospital. Rainbow is a children's hospital. Then followed by Global Health. Global Health is that HCG only.
HCG. Yeah.
HCG.
Cancer.
So more cancer patients. Okay. And Narayan Hudalaya 30%. Max is 29, and then Apollo is 21. Now, if you see KIMS, okay, when we analyze the chart, we'll see KIMS, what has happened. Okay. So how growth has happened, and we'll see, first we'll see how additions have happened. CWIP. You can see suddenly this gross block 400 crore, 600 crore, correct?
Yeah. They
So-
acquire new hospitals.
Yes. So what is good? Acquiring new hospital is good, or building a hospital from scratch is good? What is good?
Acquiring hospital is good because it is already functional and the cash flow is good.
Very good, Dr. Pawan. So what has happened is already some patients will, or they will have, that hospitals will have some name, correct? So slowly, what large group, that is why you see so much merger and M&A activities in hospital sector, okay? Rather than starting from scratch, okay, gestation period of 2-3 years, you can directly acquire a hospital and just start. So what happens is, if you see Max Healthcare, Bombay Nanavati Hospital is acquired by Max, and then you can see the operational metrics of that particular hospital has also improved. Okay. So when you see this sudden jump, now when you see the price, okay, KIMS, what would have happened is, see KIMS. You can see the growth, correct, from 1,000 rupees to 2,000 in last 1 year, correct? Correct. So when you see this CWIP, and again there is some more, correct, and then gross block, you can see from 1,000 it has almost doubled, correct? So always keep a check on CWIP. It's so important. Everyone is able to understand why CWIP is so important. Okay, and how they are doing that, whether they are doing through acquiring the hospital or they are doing through own expansion. Okay. Then second was Apollo Hospital. So let's see Apollo Hospital, how is the growth? CWIP. So gross block 8,200, 8,520. Already it is so large. It is not making material. From 8,200, on a base of 8,200, they added only 600 crores. That is only 10%. But there it is 100%, correct? So where you will find price movement of share more if it is executed properly? In Apollo Hospital or in KIMS?
I think KIMS.
Correct, no? Because there it is 100% addition of hospital asset, correct? Fixed assets, correct? So CWP is very, very important. Now, when we see Narayan Hodale, okay, how much 1100 crores or 1000 crores they are telling, okay. So when you see CWIP, what is the existing gross block? 2400. 1000 crores they will add. So almost 60-70% will increase. Yes or no?
Yeah.
So if you see the Narayan Hodale, no, it may not be very, it may not be a huge jump in share, but I think now, because they have already established some hospitals and you see the chart, okay, now you can see this breakout and gap up, correct? And then now this one more gap up, this last result after this result. So I feel now next 2-3 years, there is a good, decent growth can come in Narayan Hodale, okay? Because now 60-70% they'll be adding gross block. And how they will be doing is, I have mentioned in a note, okay, here. Only I mentioned, I think. Here. So what they're doing is 250 crores. They're doing in Calcutta and Bangalore. Calcutta, they're acquiring land, but in Bangalore, they're just extending they have a land already, just extending it. And Cayman Islands also, they're doing expansion outside India. Okay. So I think they will do good actually. So, and some they have observed, they have a target to acquire running hospitals also. Okay. So
Yeah,
here,
and Neeraj, they are going to start health insurance. They got a license already.
Yeah, so that also I'll come. Okay, what I'll show the PPT. Okay, the best part, what they are doing, which this is the PPT. So because you have discussed now, I can just discuss now. Okay, so what I liked about this now, see, this is comprehensive health integrated solution. Okay, now if you see this now, first they are starting with Bangalore. Okay, why, anyone can tell me why it is good to start with one location and then extend to other locations?
Yeah, already they've gained a name in the market in Bangalore and in the south as such. Earlier it used to be only heart care Narayan Hrudayalaya, but slowly
Yes.
they changed the name and turned it into multi-speciality.
Correct. So what will happen is they will gain some experience. It's not like you just do all across all over the locations and then something goes wrong and then you go back, correct? So always makes sense. You start in a small one location, gain some experience and insights, and then implement in other places. Okay, so that is the best part. So that is what they're trying to do actually. Okay, so if this is a success, I think this will be really re-rate the stock actually. Okay, so let's see how that goes. So good point. I wanted to discuss, but okay, later, but okay. Okay, so best part is they are doing first in one location. If they feel they will get success, they'll implement in other places. Okay, so that is a good part. Good. Now let's come to key operational metrics, how we should analyze hospitals. So occupancy rate. Okay, so one is occupancy rate. What is occupancy rate is how many number of days bed is occupied and how much capacity we have. Okay, so here I've taken one example. Say, for example, our hospital is occupied for 25,000 days. Okay, and there are 100 beds. So 100 beds into 365 days, correct? So how many days beds are available? How many beds are available?
100 beds.
And available for how many days? 365 days, correct?
365
So
days.
36,500 days are there. correct?
Yeah.
For the hospital. Now say it is occupied for 25,000 days, correct? So what is the occupancy rate?
68%.
25,000 divided by 36,000, correct? So Narayana has an occupancy rate of 65%. Okay. Now here one thing we should keep in mind is, one very, very important point is, so how do you calculate? So what you do is total revenue and you divide it by per occupied. Sorry. So it has 65% occupancy rate. Okay. Now here one thing you should keep in mind is, say there is when you're doing analysis, okay, say there are two hospitals, hospital A and hospital B. Hospital A is a mature hospital. Occupancy rate is 70%. Hospital B is growing. Occupancy rate is 60%. Market cap is 25,000 crore. Here market cap is 2,500 crore. Operational beds currently now is 2,000 beds. New capex coming, it will add 200 beds. But hospital B, current operational bed is 600 and new capex coming 700. In terms of investment, where should be our focus in terms of analysis? More analysis. Where we should do more analysis? Hospital A or hospital B?
Hospital B.
Why?
Because hospital is already stabilized.
Hmm.
And hospital B is about to start.
So hospital B, what can happen is, when this 700 will add, what will happen is the number of beds will increase to 1,300, correct? Almost more than double. So what will happen is,
Yeah.
if this hospital is doing execution correctly, there are chances that this investment can give good returns, correct? So, and here addition is only 10%, correct? New addition is only 10%. Whereas here, new addition of beds is almost 116%. Correct? So opportunity here is more, correct? So very important, why we should observe capex, even though occupancy rate is less here. Another reason why occupancy rate can be less is, if the company hospital is already in growing phase. So every year they're adding some more hospitals. So what will happen is, when you divide occupancy by total number of beds, now new hospital will take some time, correct? So you will see low occupancy, correct? So
Yeah.
that also we should keep in mind, okay, when you're analyzing occupancy rate. Okay. So now, so hope this is clear. Okay. So occupancy rate is very, very important. Normally more than 65 to 70% should be occupancy is a good matrix. Okay. Now coming to second matrix we should observe is average revenue per occupied bed. Now what you do is, per bed, how much they are generating revenue. So what you do is, you just divide total revenue divided by
Number of
per
beds.
occupied bed, because your occupancy rate is only 70%. No. So how much is your
Ah, yeah.
occupancy you divide, correct? What is not occupied, you just leave it. That's why I have mentioned the formula also here, so that we don't get confused. So per occupied bed you should divide, okay, because there may be so many beds which are not occupied, correct, during the year. So that will give you a correct matrix, that per bed how much hospitals are generating. So if you see this, okay, sources I forgot to mention trendline also. So I have taken most of these charts from trendline also. So just a disclaimer. Okay. Now, if you see here, hospital chain see a healthy rise in per bed revenue on better pay mix. So rise in revenue per bed. Again, you can see the schemes coming top in the chart. 22% growth. Max 11%. Narayana 11%. Apollo 10%. Global 8%. Rainbow is minus actually, because I think they have a high base. So very, very important that how much is the growth in revenue per bed also. Okay. Now here I'll share one very important insight. Okay. When we're going through the con call of Narayana Hodale, see revenues, if you read this, revenues have grown, which have grown more than double digit for 2 consecutive without any meaningful bed addition in actually a proof of that. What is this is? their revenue per bed actually has grown in double digit, and then you can see here it has grown at 11%, correct? Because you see the capex was not very high. Now they have started doing huge capex. So per bed, what is happening is they have improved the mix actually, like what we discussed now, correct? Cancer patients, oncology department is there, or different department. So what is happening is they are managing their mix very well actually. Okay, so that is how you should think of average revenue per occupied bed. Okay, then third matrix is average length of stay. What is average length of stay? Anyone?
I mean, the number of days that person stays
Yes.
before discharge.
Very good. So it should be less or it should be more?
It should be less. Turnover should be more.
Yeah, very good, doctor. Paul. So what happens is, see here now thought process is changing. If what happens is once the major surgeries or operation is done, then hospital and test and all everything is done. Then if patient stays, what will happen is only what will generate? Room rate.
Medicines.
Medicines and room rate.
Medicines
Correct.
and, yeah.
Correct. So then what happens is for a hospital, if demand is good, okay, now when I go to Apollo Hospital, Jayanagar, or 2-3 hospitals, or say Manipal, Domblur, there is no rooms actually. Okay, so if they are not churning out the patients fast, the turnaround time is high, then they are losing out on new patients, correct? So what now all these hospitals are trying to do is, as soon as the surgery is over, patient is stabilized, they try to discharge. They don't want to prolong that customer should stay in the hospital. Okay, in that matrix, Narayana is one of the best in the industry, because now they're introducing robotics actually. Okay, so robotics, what happens is your surgery time is less, it is precise, customer gets a patient gets well fast, recovery is fast, and you can admit new patients, correct? But in terms of claim expense, this is nothing to do with analysis. Just I'm telling, if you are a share insurance person, and if you are going to a hospital and hospital is telling you that they are going to do robotic surgery, please make sure that particular robotic surgery is covered in your insurance plan, because there are so many surgeries which are not covered into insurance. Okay, traditional surgeries are covered. So just an input from my side, from my out of experience. Okay, now, so what Narayana is trying to do is, when you listen to the con call, is they are trying to do more and more robotic surgeries, introduce many robotic surgeries. Okay, so that the churn is fast actually. Okay. Now, fourth met, anyone has doubt? Anything? Till now, anyone has any doubt? So I would like to just cover that. Okay. Take it. Fourth metric is payer mix. Okay. What is payer mix? What we discussed few points, like for example, you are getting walk-ins from insurance, government, more insurance patients, international patients. Okay. And how do you optimize that? So if you see now slowly, for example, KIMS has earlier 1 or 2% foreign patients. Now they're planning to increase it to 5 to 6% KIMS. Okay. Narayana Hrudayalaya is doing very good actually. Okay. So they are focusing on medical tourism. So when foreign, when it becomes when you get foreign patients, you can charge little more actually, correct? So margins will improve, correct? And also what generally they do is, they in Cayman Islands, what they have hospital, they generally send doctors from India to there. So again, you have a cost little less compared to what doctors you have there, or sending nurses from here, correct? So 2-3 years generally they send. So I spoke to few internal people that will generally they send from here. It's called like 2-3 years job there. So 2-3 years is fixed and they will go and work there. Okay. So how you manage your cost and how you manage your revenue stream, very, very important. Okay. Pair mix. So it will help you to improve your margins. Okay. Now coming to financial metrics. So financial metrics, we already saw that how is the revenue is growing. So we saw for how revenue is growing here for Apollo and for other. So highest is for KIMS. Okay. No, sorry. here, revenue growth. We already saw around more than 20% is very good actually, correct? So now coming to margins, how margins are. So if you see Q4 22 margins and 23, I think some hospitals, they have grown the margin, some it is less actually. For example, KIMS, it is little less from 30 to 27. For Max, it has increased from 20 to 28. Rainbow, it has increased from 23 to 31. Even though there, if you see the, when we analyzed their revenue, revenue per bed has come down -6%. But sorry, from minus it is 0 actually, but margins have improved for Rainbow Hospital actually. Same thing with Narayana. It has increased actually margins from 14 to 19%, but average you can say around 15 to 16, and now current quarter it was around 25% EBITDA margin. Okay, so that also I have highlighted here in the Excel. And Apollo Hospital is around 11%. It will come down. Okay. So obviously then impact will be on EPS. So higher the margins, higher the revenue growth, more will be the EPS. So EBITDA margin current quarter is 25%. Okay, so I have highlighted that. Now CapEx. So this we already discussed. How you are funding your CapEx, through debt or through equity. If you are funding your CapEx more from internal accruals is good, or more from debt it is good. What is good?
Internal accruals.
Yes. So more internal accruals, it will be good. So Narayana is almost, if you see their current debt levels, okay. If you see their current debt levels, total borrowings less cash, bank balance and current investment was INR 188 million, representing a net debt of equity ratio of how much? 0.01.
Negligible.
Negligible. Okay. So you can see current investment 265 crores, cash and bank balance of 555 crores. And what is the liability? 841 crores. Correct. This one latest con call, latest quarter results. Okay. So when they are expanding, they have very good scope to do capex actually. Correct? Yes or no? They have very good opportunity, correct, to expand.
Yeah.
So here, but one thing we should keep in mind is what will happen is if they take little more debt, earlier we have analyzed when you increase the debt, what happens? Your return on equity will increase or decrease?
Decrease.
Increase. Debt, if you take more, you are putting less capital, return on equity will increase.
Okay.
Okay.
Mhm.
Because you are fueling through debt. Okay. So if something goes wrong, then what will happen? It will go for a toss, correct? So you have to be very, very careful, the balance of debt and equity. Always keep in mind, any company fueling too much on debt, then interest cost will wipe out. If something goes wrong, interest cost will wipe out. What was the best example? Last time we discussed, I'll just take quickly one example so that you should be aware. Anyone remembers? Bharat Wire. Now they have stabilized, and then you can see the stock performance. You see the debt they took. Borrowings. How much? 500, 600. Suddenly 42 to 200. 200 to almost in 2 years. How many X? Almost 10X. See, 440 to 500, 600. Correct? You can see this, correct?
Yeah.
Yes or no? Correct, no?
Yeah.
From 2015 to 2019, more than 10X debt. Okay. What happened to profitability? 2015 to 2019, see, EPS minus 9 rupees. They're not able to handle. Correct? Revenue, see, not grown. Has revenue grown 10X? Or are they earning enough? How much is the interest? Their operating profit is 18 crore. Interest cost is only 25 crores. Operating profit 19 crores, interest cost is only 73 crores. See, and what happened? Price crashed. Bharat Wire here. So you can see this crash from 2018 to 202 rupees, 50 rupees. Imagine someone who is holding. Now it has picked up because now they were able to manage. Now what happened? Can you hold the stock if you don't do in such kind of so much fuel debt? You have to be little careful. Okay. So that is where industry analysis is very important. Where if hospital is doing a capex, you have established hospital, they know everything, correct? So chances of happening like this is less. You're getting a point. Why I'm telling why industry is so important, correct? Why in the first place when we are starting, we should think which direction we are going. What is the tailwind, correct? So very, very important. What is happening, how growth is happening is very, very important, which sector we are doing. Okay. So I think hospital generally they are able to manage. So that should not be a problem. Okay. Like that. Take. Then. Okay. So this is clear. So I think Artemis one day we will take Artemis also because Artemis also I'm invested. It's a small hospital, but large group, very well funded group. Promoter holding is very good. Narayana also promoter holding when you see is very good. So one thing what I see whenever I want to invest, okay, it's very important that promoter holding should be very good. How much is the promoter holding for Narayana Hrudayalaya? Promoter holding? How much is promoter holding? Narayana Hrudayalaya? %63%? 64%? 64%? It is highest among all the hospitals.
Yeah.
That shows the confidence of the promoter. Though everyone has confidence, I'm not denying, but when you have high promoter holding, it gives you a lot of comfort actually. Okay. So very important that we have high promoter holding. Okay. And if you see the shareholding pattern now, what is FI holding? 11%, correct? So we have analyzed so many times. So how to see this? So how much is the public? General public?
13%.
Only 13%, correct? So this is long-term capital, correct? This is not trading capital, trading holding, correct? 13%. So 13%, what is the market cap? 26,000 crore. How much is with the general public? Around 3,000 crore, correct?
Yeah.
So this is a very good sign actually. Okay. High promoter holding. Okay. Now, next way to analyze is EV to EBITDA. Okay. So enterprise value to EBITDA. So how you calculate enterprise? So when you calculate different hospitals and you're planning to invest, you will see how much what is the valuation, correct? In terms of, say, when you're with the best. So Apollo Hospital, what is the enterprise value? What is the Narayana? So if you're planning to invest in Narayana or you're planning to invest in Shelby Healthcare, Global Rainbow Hospital. So you'll compare, correct? What is the general average enterprise value and how much you are paying for that particular hospital, correct? Yes or no? So how do you calculate enterprise value? If I want to buy this whole company enterprise value, what you do is market cap. For example, Narayana Hrudayalaya market cap is 26,000 crore. Debt was how much? How much was the debt? 841 crore. It is in million actually. So 841 crore, 10 here, 841 crore. And cash available. How much is the cash available? 555, 265, almost around 800, correct? So maybe around 41 crores you can add. So 26,000, not much difference. So 26,000 crore is the enterprise value divided by EBITDA, correct? So now here I have taken the snapshot. So when you see enterprise value to EBITDA, Apollo Hospital is trading around 29 times. Narayana is trading around 18 times. Shelby is trading just 9 times. Aster is 10, 14. So we cannot just go purely by EV to EBITDA because then Shelby, there is a growth or not. If they're not doing any capex or anything, it will just remain there only, correct? So you have to what we have to see is growth also, correct? So that way, when you compare with Apollo hospitals, it is lower, correct? Narayana Hrudayalaya, correct? In terms of gross block, what was the gross block for Apollo hospital? Anyone remember? Some 8,000 crores, correct? Gross block, correct? Wait, I'll show you. Apollo hospital gross block around 8,500, 9,000 crore, correct? Roughly. If I add this CWP, it is 9,000 crore. How much is for Narayana Hrudayalaya? 2,500, correct? So almost it is 3 times Apollo hospital. Apollo hospital is 3 times of Narayana Hrudayalaya, correct? So if there is a growth in the stock you're planning to invest, I think makes sense to look into all these hospitals wherever, say, Aster is planning capex, Healthcare Global is planning capex, or they're planning for acquisition. We should be very alert, correct? It may result in re-rating. For example, Healthcare Global, EV to EBITDA is 14, less than Narayana Hrudayalaya. Suppose here huge capex is coming, it will give you some comfort, correct, in terms of valuation. Return on capital employed, and that is the reason you see return on capital employed is just Healthcare Global is 8.8, and that is why valuation is also less. Market is giving less valuation to Healthcare Global, correct? Return on equity is so less, 3.6. You can see 3.6. Return on capital employed is 8.8, correct? So that's why EV to EBITDA is also 15 times. Yes or no? Same thing with Shelby. Why? Shelby also same. EV to EBITDA 9. Return on equity is just 8%. That's it. No capex.
It's only one hospital, I think.
That's what. There will be no growth actually.
Yes,
So that's why if there's no
hospitals,
growth,
yeah.
what valuation they will do, like that, correct? So these are the things we should keep in mind. Okay. And yeah. And how much generally revenue growth we are expecting now? FY21 to 23 and FY23 to 25. So growth, you can see high double digit actually, correct? Estimate. So earlier growth was very high, 35%, but max now they're expecting 31. Rainbow around 19%. Earlier it was 34. Apollo Hospital 25. It has come down to 18. KIMS Global Narayana 11. Correct. And hospital stocks are commanding high current and forward earning multiple. How much? You can see here Apollo Hospital has the highest. So this is July 23 data. Okay, from where I took the report. Now it is around 99 times. Global Health is 50, 34. Narayana is trading around 35 times. Okay. So these are the things you should keep in mind actually. Okay. So that is all I wanted to cover when you're analyzing the hospital. So I covered different metrics. Okay. How a business model, diversification, competitive advantage, key operational metrics, and financial metrics, and how to do that. So that is how. Please keep in mind when you are analyzing the hospitals, and then I'm doing some summary of these metrics. So next time, maybe when we do a presentation, I'll having data for different hospitals on to summarize. Okay. Different metrics, what we already discussed: average revenue per bed, occupancy rate, EBITDA margin, how much new beds are coming, capex, how capex is funded, debt or internal, current debt position, promoter holding, and experience of the promoter. So this I'll summarize. Okay. And then maybe we'll have some very good, beautiful insights, which we'll see. Okay. So that's all for today. Anyone has any doubt, please ask me. I hope you got some insights on how to analyze the hospital. Okay. In-depth analysis. Anything else or any doubts, please feel free to ask. Or any particular